So volatility is one of the ways to identify if the market is nervous. The volatility index that we're showing in this slide just shows you the three most extreme points that it ever got to. One was during COVID, as was understandable. No one knew how this thing was going to unfold. The other one was the global financial crisis back in 2008. And again, extreme circumstance was the second worst period. But the uncertainty that followed the tariff announcements after Liberation Day was actually the third highest period that this index got to. So just showing how much uncertainty there was in the market. Something seems to have changed recently. This graph just shows us currency, which is the blue line, the euro versus the dollar. And then the green line just shows you short-dated bonds in Germany minus the short-dated bonds in the US. And typically what happens is that as the bond markets move, the currencies move in unison with that, and hence the two lines following one another. But what we've seen of late is that this unusual movement suggests that investors are losing some confidence in the US bonds, and they could be shifting their money to European assets or bonds, and that has weakened the dollar beyond what the market had predicted. Part of understanding markets is trying to understand what the different decision makers who buy into the markets are doing. This survey just shows you what different asset managers have done most recently, and the graph on the left just shows what asset managers are thinking. And if the bars are above the line, then the managers are overweight US equities. If they're under the line, that means they're underweight. And we've seen in the last sort of 2-3 months up to April this year that managers have changed their views and are talking about being underweight the US equity market later into this year. And where is some of that money gone? On the right hand side, it just shows you what has been happening in terms of flows into the gold market. Gold is often a place where investors will flee to for safety. And when there's uncertainty, we've seen that happening of late, and that's why the gold price has also been going up quite a lot. So you'll know if you've watched this at all that we pay attention to valuations. Are shares or assets that we're going to buy cheap or expensive? We'd rather buy them at a cheaper price than an expensive price. And the US equity markets have been expensive, and that's what the slide shows, that previously on a forward price earnings ratio, well over 22 times, getting close to 23 times, which is high. You can see it relative to its own history going back 20 years. In the last couple of months, and particularly in April, we've seen that drop significantly, and now it's actually within one standard deviation of its long-term average. So a much more comfortable picture, but the uncertainty around future earnings still needs to play out. So is it time to be greedy or not? I just want to pull out two things from this slide. The first one is, if you have a reasonably long period of time, the probability of losing money gets much, much lower. If you are just invested over a day, there's almost a 50% chance that you'll lose money. However, if you are thinking about investing over the next 5 years, there's only a 10%, a 1 in 10 chance that you could lose money. Or put differently, there's a 9 in 10 chance that you'll make money over that period of time. The second table here just looks at the benefit of being in the market. If you're trying to job the market in the short term, it's very difficult because markets can move so quickly and so rapidly. And that table just shows that different decades over the last 80 years, what returns you got if you just stayed in the market. You didn't try to find the good days or the bad days, you just stayed in the markets. And you can see that price return column giving some significant returns. And that's really what we're about at Core Wealth. So we started this video by talking about when to be fearful or when to be greedy. And that quote actually comes from Warren Buffett, and he's got this quote that you can see on the slide. I'll tell you how to become rich. Close the doors, in other words, get rid of distractions, be fearful when others are greedy, and be greedy when others are fearful. One of the main things we're trying to do with you as our clients is ensure that you don't get fearful when you should be greedy, and vice versa. Don't get greedy when you should be fearful. And that's really looking through the noise, which we have the benefit of seeing a lot of research and analysis, and that helps us help you make good decisions. Thanks again from me, Kevin French at Core Wealth. If you want to watch the full video of this monthly wrap-up, please head over to our YouTube or LinkedIn channel.